Ignore the metal prices, ignore the prices in gold and silver. I know the news you're hearing gold at an all-time high and silver at a 13-year high. And what people think is now that it's at an all-time high, it's time to take profits. But real cold-hearted investors, they use numbers, they use graphs, and they use indicators to understand where gold and silver is really at. And when you understand this, you understand that gold and silver has got plenty to go. So in this video, I'm going to be showing you some indicators which I use to be able to help invest, and that other top end investors use to be able to value gold and silver and understand when to sell and take profits. First metric that everyone loves to use is this thing called the Dow to gold ratio. The Dow is basically this index fund that tells you the 30 most prominent US companies and what their value is. And by comparing this to gold, you can see where the stock market is valued compared to gold and when to shift your assets away from gold back into the market. You can see how overvalued or undervalued the stock market is compared to gold. And if you look at this graph on a historical level, what you can see is the market works in cycles. We have periods where the stock market peaks, and that's when we consider the stock market to be overvalued. And then what will happen is a downturn will happen where gold will continue to be valued higher. And when it has this dip, that's usually your time to get out of gold and move yourself back into the stock market and get back in the market. If we look at where we are today, we had a downturn in 2008. That downturn, however, wasn't proper enough, and there's still a lot of energy in the stock market right now as it's heavily overvalued. The general rule we use is that gold is fairly valued when it's at 6 to 7 compared to the Dow ratio. Right now we're still well at 12, which is high. And when it's considered to be around under 4, when it gets down a lot, that's when you understand that gold is valued high, and that's when you need to start getting out. To show you another graph, this was from the gold and silver channel. You can see what happens with the Dow to gold ratio. Basically, it has this pendulum effect. Think of Newton's third law. For every action, there's an equal and opposite reaction. And what's happening here is basically the higher up it goes, the higher down it goes. And the higher up it then goes and increases again, the higher down it goes. There's a prediction that on the next downturn, based on Michael Maloney, we're going to see the Dow to gold ratio go to 0.5 on this next run, meaning gold is going to be worth double the value of the Dow. And when you shift your gold assets into the stock market, you're going to be getting everything at a bargain and getting a really good deal. So this is to help you understand gold's still got plenty to go. The most common one, which everyone loves, is the gold to silver ratio. This one is the most common and the most loved by everyone. And basically what it tells you is what is the value of gold compared to silver. Right now we're sitting at 88. The common rule which we use is the 80-50 rule, which basically tells you that when the gold to silver ratio is above 80, we buy only silver. When it's between 80 and 50, we buy a mix of gold and silver. When it's below 50, we buy basically gold. But if you look at it at a historical level, we can see the average is usually around 60. And when things normalize and come back to normal, it usually sits at around 30 if we look at it on a 20-year level like this one. And if you mix the Dow to gold ratio with the gold to silver ratio, you see the Dow to gold ratio has come down, as well as the gold to silver ratio returning to its natural value of around 30, and things have resettled back into their normal form. That's another sign that the markets have shifted and now it's at its bottom. When it's at its bottom, that means gold and silver truly are at their highest value, and you know you've maximized your profits. So not only is it an indicator of which asset to invest in, but it also tells you where it's at. When we're at values like 80, it means we're out of proportion right now and things need to be adjusted. The next one, which I like, is the gold to monetary ratio. And you're considering the value of how much gold is compared to the amount of toilet paper we've printed, the amount of gold, the amount of currency that we've printed. Because we print so much money, you need to consider how much gold is actually worth compared to that printing and if the value is fair. Basically, how the cycle works is that during any kind of grey recession period, this spikes, this value, meaning that gold is now being revalued at a fairer value compared to the amount that's printed. You can also see during that like 08 period, it peaked, it went on a shooting run as gold went and got revalued. The general rule is that when the value returns to about 1, that's when gold is valued fairly again. And compared to how much crap is being printed, it's now returning to fair value again. Right now, we're currently at 0.47, meaning gold's heavily undervalued right now. Even though it's at its all-time high, compared to how much we've printed, it's actually not valued that much. So you need to understand this, because at the end of the day, the money or the currency we're working in, we work in spot price in US dollars, but the money itself is actually basically monopoly money and it's fake. That's why we use indicators. That's why we don't invest with emotion, we invest with numbers. So this is a ratio I like to use as well to just check where the market is at. The next one, which I like to use, is the price to earnings ratio. This one is outside of gold and silver, and it's more of a general check of where the market's at. The price to earnings ratio basically tells you for stocks, and in this one we're looking at the S&P 500. It basically tells you what's the price of the stock compared to its earnings. And what it tells you is how overvalued or undervalued stocks are. Generally, what we can see based on this graph, that it works in cycles where stocks are considered overvalued and undervalued. The general rule is that between that 15 to 25 area, you consider the price to earnings ratio to be kind of fair. And that's a good price. Right now, we've kind of peaked up again, up to 26, as things get kind of high. And when it gets up to almost that 30 level, that's when it gets very dangerous. So this is for the S&P 500, but you can also consider it depending on the different types of industries. And you can see the issue here with IT stocks like Nvidia. Nvidia, I think, is running at like 40 and well into the 40s, meaning its price is well through the roof compared to its earnings. And although it continues to go up, it's extremely overvalued. So right now you can see it's at an all-time high, the S&P 500 price to earnings ratio. And usually when it hits a high, what happens is it goes back down. Why this is important is because when it hits a dip and it goes below 10, that means stocks are at a relative bargain. That's another sign that the market has shifted. You've now got your peak in your gold to silver, and the stock market has returned back to its low levels. It's at a dip. You can start to buy them again. So this is a really handy indicator, which I like to use. And the last one is the Buffett indicator. And this basically is a ratio which basically describes the total US stock market value in terms of the GDP. I'll put an equation up now just so you can see it. And basically what it's saying, it's one which was created by Warren Buffett so he could understand when the stocks are considered over and undervalued. When the stocks are trading almost at double the amount of the GDP, it's considered overvalued. So around that 100% marker is where it's considered overvalued. If you look at like that 07 period, the housing bubble, it got to around 100%, and then it downturned back to 56%. The general average is around that 80% marker point. If we look at where we're at today, not only are we 100% over, which is considered overvalued, we're now at 200%. And when you understand that, you understand why people like Warren Buffett have got out of stocks and they've ran the heck away. They know that these prices are considerably overvalued. And while people tend to start getting into stocks now because they think, oh, they're at all-time highs, they're really, really overvalued. And when they come back down to their natural levels, which I believe will go below 50% easily with this next downturn, that's when you know you can begin to shift away from gold and silver. understand these numbers and understand how to invest with them, because investing with emotion isn't going to get you anywhere in today's world. There's a lot of news happening and a lot of information that's spreading, a lot of wild arguments and just false information. Do your study and understand what's going on in the world today. And by doing your study, you'll know when the correct time is to go in and out with gold and silver. I hope you enjoyed this video. You've learned something. If I've provided value to you, click that like button, subscribe. I'm going to be posting more of these and trying to help you guys with investing in gold and silver. Thank you, and I hope you enjoy this video.